Have you ever noticed how the interest rate on your savings account or the cost of a loan seems to change over time? One day it might be higher, and another day lower, leaving you to wonder what causes these shifts in the financial world. Well, interest rates go up and down primarily due to a dynamic interplay between the supply and demand for money within an economy, and the deliberate policy decisions made by a nation's central bank. These two powerful forces constantly adjust the cost of borrowing and the reward for saving. Think of money like any other product. When many people want to borrow money, but there is not much available to lend, the price of borrowing that money, which is the interest rate, naturally rises. Conversely, if there is a lot of money available for banks to lend out, but fewer people or businesses are looking to borrow, then the interest rate tends to fall. This basic principle of supply and demand is a fundamental driver. Beyond this market dynamic, the central bank plays a crucial role. In the United States, that is the Federal Reserve, often called the Fed. The Fed's main job is to manage the overall health of the economy by influencing things like inflation, which is the rate at which prices rise, and employment levels. When inflation is a concern, the Fed might raise its benchmark interest rate, known as the federal funds rate. This makes it more expensive for banks to borrow money from each other, and those costs are then passed on to consumers and businesses in the form of higher rates on loans like mortgages, car loans, and credit cards. Higher rates discourage borrowing and spending, which helps to cool down an overheating economy and bring inflation under control. On the flip side, if the economy is sluggish and unemployment is high, the Fed might lower the federal funds rate. This makes borrowing cheaper, encouraging people and businesses to take out loans for investments, spending, and expansion. The goal is to stimulate economic activity, create jobs, and boost growth. So what does all this mean for you? When interest rates are rising, it is a great time to be a saver because your money earns more in savings accounts, certificates of deposit, and other interest-bearing products. However, it also means that borrowing for a new car, a home, or even using a credit card becomes more expensive. When rates are falling, it is an excellent opportunity to borrow at lower costs for big purchases, but your savings might earn a little less. Understanding these shifts helps you make smarter financial decisions. The central bank's actions are part of its broader strategy of monetary policy, which is essentially how it manages the money supply and credit conditions to achieve economic goals. Keeping an eye on indicators like inflation reports and the Federal Reserve's announcements can give you an insider's view into potential future rate changes. By recognizing that interest rates are not random but are influenced by economic forces and deliberate policy, you gain a valuable perspective on your personal finances. This knowledge empowers you to strategize whether it is the right time to save aggressively to earn more, or to consider a new loan or refinance an existing one to take advantage of lower borrowing costs. Being aware of these movements can help you navigate the financial landscape with confidence and make your money work harder for you.